Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, July 30th, 2020. What I'll do in this video is a brief update on the broad markets. We'll talk about the big earnings reports on deck tonight for the 5 market-leading FAANG stocks. And really just the point of this video, and the reason I didn't put static charts out, chart images this morning, I just wanted to kind of convey my thoughts here on where the opportunities are right now. That at least I believe to make money on the market, various things. So we're going to cover the broad markets quickly, just briefly. Again, we'll have a lot better idea which way they want to go after today, tomorrow. I'll share my thoughts where I think they're going. Make the case for that and how to trade it and what to, and really kind of, you have to be ready for it, whatever happens. If there is a big move in the market after the FAANGs report tonight, maybe it's nothing, a non-event. Sometimes that happens, but we'll see. So I'm going to go over again the levels to look at, support levels or resistance levels, levels that might spark a rally, levels that might spark a correction, and if so, where we're going to head from there. Also, another update on the ag commodities briefly. Again, that's where I've seen the best risk reward profiles. We just hit our one of our price targets on coffee today or yesterday. I'll get to that in a second. And natural gas. I want to show you something on that chart. Let's start here. We're on this one already. QQQ. Simple stuff. Relatively simple. And this goes back for years here. 2018. You look for these, divergent highs and divergent lows, and that's usually your major inflection points for the trends. And sometimes you just get little corrections after a divergent high. Sometimes you get big corrections after a divergent high, and sometimes you get big rallies after a divergent low, like this one, which really didn't end till right there. Or you could say this, however you want to look at it. There is your divergence, and so on and so forth. So let's just focus right now on what I've been looking at recently. Bearish engulfing candle way back on July 13th. Market kind of went in a holding pattern since then. I probably in large part due, well, of course we had an FOMC meeting yesterday, but that's no surprise. The Fed's already bent over for this market, and pretty much I think everyone's written the Fed off as they're not going to do anything. Going to keep rates at zero for the foreseeable future. They've dug themselves into a hole they really can't get out of. The zero interest rate thing. They tried to raise it back. That's what the tissy fit in the market was back on the fourth quarter of 2018 when they tried to start unwinding that easy money. So I think the market has resigned itself to the fact that we're going to have easy money as long as as far as the eyes can see. All right, so that's that. Again, Fed was pretty much a non-event yesterday, as expected, and levels I'm still watching are break of those lows that came after the day after that bearish engulfing candle. We've had a couple tests of that, and to do that we'll also take up the trend lines and the targets I talked about. Minimum right there 242. Next target down there is about 229 or so, 68 on QQQ. And maybe more. We'll see. Again, there's the charts are stacked right now. We have divergences rolling all the way out. There's RSI divergence there on the PPO, the weekly chart. What I just flipped over the weekly chart. Here's what SPY looks like on a long-term chart. Put in a divergent high here and still never even took out that high. So you couldn't have divergence on the weekly right now. You could if we go up and make a marginal new high, so that's something we'll watch for. In other words, these indicators are lagging, but this is not negative divergence because you need to have equal or higher highs in price. And so we'll see. Let's see where things go. I want to just take a quick look at the futures. And although trading overall has been sloppy and choppy, swing traders pretty much, and whether it's the S&P 500, QQQ, or most of the stocks within there, have gone nowhere for last month or so here. It's been a choppy sideways grind. There's always opportunities to make money in active trading, and that's what I post usually on these charts on the that come out in the morning or throughout the day on the futures. Let's look at this one. So this is NQ. Here's their 60-minute chart, and it's just amazing. I'm going to loop back to some of the recent charts here, but you can see these levels, and note these levels. They have not changed in weeks. 1, 2, 3, 4, and this is a zone, a support zone. And you can see back here, before we even broke down, I'm going to get to that chart in a second, my prediction, preferred scenario was this, that we would go to this point right here and then have a reaction, a reversal. And that's exactly what happened. And from there, not only that, I'll get to that chart in a second, you can see how each of these levels, again, they're all added here before we even broke down, how each of those levels came into play. Numerous reactions right there on the initial bounce. We broke above it, then we back tested it from below, then we shot up here, hit that top resistance level at 10,773, pulled back down, and wasn't just a random stop. So say what you want about technical analysis, but I think it's hard to argue that the the algos, as well as humans, that write the algos, they're trading themselves or they're letting the algos do the trading. It's hard to argue that these levels are not significant. Again, to have outlined those in advance, and of course couple successful taps there, a bounce up to the next resistance, pull back, and that's where we are right now. So we've been playing ping pong almost perfectly between these levels. Here, let's go back. Today is, of course, the 30th. So we go all the way back to this chart. It was posted on July 23rd, so a week ago, and there it is. So the darker arrows mean preferred scenario, lighter arrows will mean alternative scenarios. So that's where we were, and that's exactly what happened. I just showed you. From that point, we did that and went to the button. That's where we hit the bottom of that support zone at 110,289, and then bounce from there. That's where the arrows stop. The alternative scenario would have had us going on had we bounced and held the trend line, put in a marginal high, and still got to the same point. So it was just a matter of, was there a little more upside if we didn't break down right away. But either way, that's where it had us going, and of course that's where I just showed reversing. And then from there, the next update was this one here. Yep. And so really, how did how did the market get there? Let me go back one more. No, this one first. Yeah, it was this one. So here's how we got there. We broke down from that point. We were right there. We broke the trend line, had an impulsive drop, set up a little bear flag, went down, kicked back at that point, and again, this was posted on the 24th, saying this is an objective short entry to that last leg down to hit the final target, and then cover and get out. And that's what happened from there. The final chart posted was this one the other day, where we had this larger flag. Now keep in mind, we already hit the target. This was on the 27th, just a few days ago. We already hit that bottom initial target that I had us going to at 10,289. Had this bigger flag pattern, and I said sell signal would come if I break below that pennant, and had arrows going here. But I also, at the same point, that was on the 27th, said that was it. I gamed a lot of those reactions, but then it was time to step aside. So that was on the 27th right here, this post, stock futures deja vu. But I went on to say that's it. We're getting now too close to the earnings. So until then, expect a lot of chop and slop. Personally, I'm going to take some time off today. As charts are going to be whippy between now and then, and that's pretty much what happened. Go back to the charts where we're at, the NQ we were just on. We never even got that sell signal at that point. Here it is, updated chart. This was that potential larger flag, but it never broke down. So you can see I had it drawn out here. We just went up and hit that target there. Finally did break the trend line, got a sell signal, but we no longer had a pennant right there. You can see it was stretched out. And again, we ping-ponged off there. This is a live chart. All right, what is that all about? Well, again, it's active trading. There's opportunities. There's always opportunities most points in time. Sometimes I like to step aside when the charts aren't clear, but to game these little 1%, 2%, 3% swings. And if you trade NQ or even the minis, the micros, what an MNQ, you put an M in front of the NQ on your futures, and it's I think they're 1/10 of the size. So if the big contract, the NQ, is a little too much for your taste, you can always trade the MNQs or the MES, and just gives you the same exact chart levels. You can use these charts that I post. They just have a smaller leverage factor, like I said, about a 1/10 smaller than the NQs, and you can still day trade those and actively trade overnight. I prefer it over the Qs because a lot of these levels, these inflection points off these support and resistance levels in the objective long entries or points to cover come after hours or early hours, And although you're not a robot, you can't trade 24/7, you can certainly use those what I call OCO orders. One cancels another, where let's say you covered your short there at that when that final target was hit, the 10,289, and you reversed to a long. What you would have done maybe is one of two things: either just set a trailing stop. You could set an OCO. Let's say you wanted to just game a bounce to that first resistance level, so you set a sell limit order at that point on your new long position after you recovered your short. Sell at 10,508. You do it good to cancel, so it'll stay on. Not expire at the end of the day, and then you have a stop just below, so you're minimizing your risk if you happen to break down and continued on through there, and if that level was hit at, let's say, 3 in the morning, guess what? You'd wake up to a executed order, a profitable trade. And the thing is with QQQ, that may have happened, and then you could have reversed, and Q's opened up the next morning, and you never had that chance to exit. Okay, before I move away from the markets, just again, I said we mentioned the FAAMGs, and we already have breakdowns. We have sell signals. Doesn't guarantee they're going to play out. Earnings can sometimes foil the best bullish or bearish technicals on a stock, but I've said it often, been saying it for years, much more often than not, when a stock is clearly has a clearly bullish or bearish technical posture heading into earnings. Here's the earnings on Apple right here. You can see the previous earnings dates. Remember, they reported after the bell. That was the day of the earnings, so the next day was when whatever happened. So let's go back here to January 28th. At that point in time, I had a clear bearish rising wedge pattern. I had a nice clean uptrend line, and Apple had just broken down the day before that. Look at that. Came and back tested into earnings, popped the following day. Remember, this is the day of earnings. I don't know if you can make it out, but I have a vertical line right there on the earnings date. Broke down the day before, and so you had not only a bearish technical posture with the wedge and the negative divergence and overbought conditions, but you had a sell signal. Now, I probably said it back at the time, and if I didn't, I'll say it now, you would have had to take it with a little bit of grain of salt, because earnings could, foil that, but they didn't. It popped, and actually earnings must have been good because the stock went up the following day, made a back test of the wedge, stalled around for a while, didn't immediately sell off, extended the divergence to that point, and then boom, the 30-something% drop that ensued. You can call it Corona if you want, but again, Corona and everything going on in the world, coronavirus didn't start in February. It started somewhere back here. Cases, it's a little fuzzy where the first one started, and it had been building. So, in other words, the news is factored in. The news and the charts go hand in hand. They're not mutually exclusive. Things like this, divergences show waning momentum during an uptrend, or waning momentum during a downtrend, when you have divergent lows. And that waning momentum is caused by supply and demand forces, less and less buyers, less vigorous buying. And so it's really, I don't know, oversimplified, but that's how it works. So there it was, clearly bearish technicals, and it played out. Here we were, the previous earnings, or the last earnings, April 30th, and it was a bullish looking chart. Apple, I pointed out in the 60-minute chart, Apple and a lot of other things had positive divergence. You got divergence here even on the daily on the RSI. 60-minute chart, we had clear divergence across the board on just about all the QQQ and all the FAANG stocks. That was pointed out then. So it was a bullish technical posture. A rally had started. It was clearly in an uptrend, no divergence, not overbought or anything like that. And they reported April 30th, and it just, it kept, continued to rally from there. It wasn't an inflection point, but again, it was, in a bullish trend, and above the uptrend line as well, continued that trend, and here we are. So we've come full circle. I just wanted to point out again that the technicals are clearly bearish heading into this earnings. We already had a breakdown. We already put in a divergent high. The stock has already broken down, and I would rather be wrong than not be clear on my convictions that this is clearly bearish technicals. And so the one last thing I'll add is, the initial reaction, even the following day, as you saw back here, is not always the one that sticks. In fact, we go back many times over the years, particularly with Apple. I can recall blowout quarters. Apple always just blows it away. They just, it's an earnings juggernaut. But what happens is, how much of that is priced in to the rally leading up to their earnings report. So a lot of times you get a buy the rumor, sell the news. And so sometimes they drop immediately, sometimes they go up. And I'm talking the times where earnings are an inflection point, in other words, after an uptrend. Sometimes they go up for a day or two or even a week and then collapse. So I just want to caution that if we don't drop tomorrow and the stock goes up, doesn't negate the bearish technical posture. If it continues up for a while, divergences are burned through, and I can no longer make a bearish case, then I'll say, hey, that's that. But as of now, that's where I think the stock is headed. First target there, about 354.50, 327.04 minimum target for me for swinging Apple, and that would be about a 13.6% drop. And if Apple drops 13.5%, I can all but assure you the stock market's going to drop as well. Microsoft already went over, bearish engulfing candle. They reported earnings here. And since then, it's kind of stalled out. It's gone down a little since earnings. The earnings report was right here, but not much. It's hanging on this 201.35 support with some trendline support below. Remember, Microsoft was the first of 5 FAANGs to report. The other 4 are tonight. So, depending on what they do, or more importantly, what the market's reaction is to whatever they say. Again, it's not about good earnings or bad earnings. I've seen companies miss expectations, come out with lousy forward guidance, and the stock goes on to rally from there. And I've seen companies below the cover off the ball, great rosy earnings, beat expectations, nice outlook, and the stock tops. So it's not always that way, but I just want to say that sometimes it is that way. It's all about supply and demand forces. It's pretty simple. If everybody's already bullish and long, and the last bull has bought his or her share of Apple or Microsoft, and they blow out earnings, who's left to buy? So at that point, everybody's all in, and I'm speaking metaphorically, generally speaking, not literally. But at that point, you have nothing but sellers, especially after a big run-up. And that's why sometimes you see those things, and people just can't wrap their head around how can a stock, top after such a big, earnings blowout. Amazon, already talked about it back here, stating at the time, and still is probably one of the more bearish stocks in the FAANGs, with the breakdown, bearish engulfing candle, followed through confirmation with 4 red follow-up candles to the bearish engulfing stick, plus the trend line break. But like everything else, that breakdown occurred shortly before they report, so the market kind of goes into a holding pattern. I've never seen, in all my years, at least not that I can recall, when you have these FAANGs always report around the same time. They're always within within a 2-week window, usually less than that. And I've never seen a huge drop or a huge rally in earnings. You always see, sometimes they'll rally, sometimes it will fall a little, but for the most part, you go into this holding pattern. Because again, who wants to take a big position right in front of earnings? It's a crapshoot. So that's why, at least what I attribute to the fact this one broke down, as did Apple and some others, but it's not playing out for much of a correction so far. It's just kind of in that holding period. So I think once earnings are out of the way, I suspect that frees up or opens the door for these stocks to go to where the technicals are indicating they're going. And if I'm wrong, I'm not betting heavy on these now. My eggs are spread around in a lot of baskets: natural gas, crude oil, various agriculture commodities, and I will go in, take some shorts into earnings tonight. And if I like what I see tomorrow, or later tonight, early next week, I'll continue to add to those index shorts. Alphabet, same thing. I'm beating a dead horse here because I've covered these, but divergent high, negative divergence on this one. Just to reiterate, for those new to the site, or just those that aren't actively trading, come in, check time to time. We broke down. This was our uptrend line right here. Breakdown, back test again, rejection, and kind of in a holding pattern here. Alphabet, and this is the Class A shares with the L at the end, GOGL, needs to take out 1479 right there. I think that's a pretty decent level. A little bit above that, actually. You can see if I zoom in a little tighter, maybe around 1500 to 1480, but let's just leave it at 1479 to be safe. I think if 1479 breaks, this stock is coming back down to at least this 1398 level at the very least, and maybe more. So how you trade it, it's up to you. You want a quick 7% drop, that's my near-term initial target. You could always set a trailing stop and allow for a lot more. With a lot of these charts, very bearish on the long term, the weekly charts. I'm looking at stocks that are probably poised for the next leg down in a bear market now. You can't say that about a lot of the FAANGs because they made new highs, but the stock market, I've said it time and time again, the U.S. stock market is still well off the highs, every major index except the Nasdaq 100, and that's really just mainly a tech index anyway. So the Dow, the small caps, mid caps, S&P 500. So this is clearly bearish stuff here, big negative divergence. And where I'm going with that is if you're swinging for the fences, this is a longer term target, about a 15% drop. Where did I come up with that number on Alphabet? I'm just picking on this one. They're all going to, if Alphabet drops 15%, the rest of the things, give or take, will also do that. That is the top. I don't know if you can see it here, this trading range. I have a box right here, this red box, and it goes right here. This stock kind of plateaued back in 2017, started this multi-month trading range, had a breakout right here, and that breakout failed, went back down to the bottom of the range once more, another breakout, and if these divergences play out, as I suspect they will, we're going to come back down into the range again, probably down to the bottom, and who knows, these divergences could play out for more. So then again, 15% minimum. If you want to swing for the fences, maybe a 35% drop, and that's pretty darn good support. So that's if we start to get down that way, if any of this starts to pan out, believe me, I'll do updates and give you additional targets and my thoughts as to whether there's going to be more downside. If we go up from here, look guys, we're at new all-time highs. There's no resistance, or right off all-time highs. There's not any resistance. So if these guys just blow it out of the water, the market rallies, they burn through these divergences, I don't have upside targets for you because there aren't any resistance levels. You can take Fibonacci projections, things like that, that'll give you some rough targets, but just trail it up. If you're long, if you're bullish and you're long, have your stops in place and just keep trailing them up and ride the trend. So that's it. That's why I'm focusing on all these downside targets, because that's how technical analysis works. At least my style of trading, and that's why I look for tops and bottoms, because I can identify levels where the stock is likely to go if the technicals play out. But something in an uptrend, all-time highs, just set it and forget it. Put a stop in place and let it run. And last but not least, here's Facebook. Same thing, building divergences. This is a weekly chart here. It's been building divergences for a while. These are just various trend lines, divergence, divergence, divergence. That's the weekly. Let's go to the daily. There it is, divergent high right there. And you can see again these inflection points. I don't have each and every of the earnings marked here, but there's the January 29th earnings. Boom, that was it. That was the all-time high at that point in the stock, and from there the stock fell after that divergent high. And earnings report dropped 38%. So you want to blame it on Corona. You want to say that's random coincidence that all these stocks topped with negative divergence and right at earnings back in January. Say what you want. Again, trend was bullish. The trend was strong, above uptrend line, and when they reported on April 28th, gapped up and it continued that trend. Now we have clearly bearish divergences and technicals, I should say, not just divergences, as we head into earnings. So give you targets. You can see some levels down here. Say about that 202 level would be my preferred swing target on Facebook if we get there. All right, let's change gears, go on to some other opportunities. If you disagree with my analysis on this, you don't want to short, or again, if you're a bull, the same levels that I talk about as providing objective short entries, or here's support it to about 222.80. So if you're a bull and you get a pullback tonight after earnings or tomorrow to that level, maybe you want to step in and buy. You hit my target down here, you want to step in and buy. Or you have a lot of embedded gains. You can use these levels as stops. Set stops a little bit below those levels, because if they get taken out, then that's not good. It opens the door to the the next support level or target. Which, by the way, I'd have to sharpen my pencil on this chart. I'm not saying that there's not any support between there, but there's not a whole lot. That's a big level right there, about 161.50. Okay, and I'm not a perma bear. I don't only short. I love going long. I love going long stocks, indexes when the time is right, sectors, and lately I've been a lot of my long positions have been in commodities. And over the years, this is wheat, things like this have been in a bull market, but more of a bottoming pattern. You can see all these previous trades, with the same patterns by wheat down here at support. Wash, rinse, repeat. We've done it. I believe if it wasn't official each and every time, it was certainly highlighted each and every time. And this one is an official trade. We already hit our first and second target, and that's why I have these targets. Active traders can book profits, recycle back in on a pullback, or just hold out for the long, for the whole thing, and try not to game all the counter trend moves between, because most securities don't go all the way from point A, entry to point B without zigging and zagging in between, and that's what the multiple targets are all about. So that's it. Still looks good. Not much else to add. Hit our second target. We pulled back to T1. Coffee hit our second target yesterday. So I've just been remiss. All the active trades. Maybe today I'll do that, since I'm not going to be trading much before. Today at all. At least on the equities. I'll work on maybe getting some of these updated. So this one has been hit now. It was hit yesterday, I think, or no, today. Today was hit. So that's whatever the gain is. We entered at 3101, so we're good for about, if I can grab it there's 31 right there. So far this one's good for about 15-16%. So and it still looks good. Potential third target, I didn't make it an official target, so I'm kind of a stickler for the rules. I'm going to have to officially close this out. I'm going to tell you that I'm still favoring that level. I'm thinking, I've been talking about this for a while. Commodities have been in a bear market for years, but the charts are looking more and more constructive. And that bear market may be over. One of these little seemingly, the great swing tradable rallies may prove to be the start of a new uptrend, a new bull market with a lot more upside to come, especially, again, when I look at the longer term charts. So I'm still favoring a move up there. I'm just going to tell you that now. Book profits if you want. But that would have, if I been in front of my desk a little more this week, I told you guys I'd be taking some time off. Because of the the big fangs reporting and the choppiness, and I should have updated that. I just want to say a kind of oversight on my part. All right, next one up, NIB. It's just a beautiful, the technicals on these have just been great, and they've been playing out recently, and we're making money on these. This one was just a simple, nice trend line, and it was highlighted here as an objective long entry on the pullback to that uptrend line with big bullish divergence. So not just a little bounce trade. I mean, the next big trend, I already went over that before. These trends range from about 56%. Actually, this was when you bought it here. It didn't end till right there, so that one was about about 50. So we're talking 250% rallies so far, 50+% rallies off there, and I see no reason, especially with the bullish divergence this time around, why this one's going to be any different. So so far we're good for those of you that took this one on that pullback to support, about a 15% rally as well. So again, we're in just a matter of a few weeks doing much better than the stock market, which is going nowhere. And so I'll continue to update these as long as the the opportunities are there. Cane is sugar. Some of these are official, some unofficial, but again, I threw them all out there. I still like it. Sugar looks good. JJG is grains, has corn, soybeans, and wheat. And that's the thing too. I wanted to mention that wheat, which is an official trade. We went with wheat, already hit our second target, has rallied nice off the bottom here, where corn is sucking wind, and they usually move together. So I think corn is going to play a game of catch up soon. We had an official trade here. We were stopped out on it, but I'm leaving all those annotations on the chart. If I put a new trade, I'll clean it up. But here it is. We're at support right now. Any new low will be still a divergent low. We had positive divergence at that low, but as you can see, if we go any lower, or even really just for all intents and purposes, we are at that low. So I'll just say these divergences are still intact. And even if we go a little bit lower, they'll remain intact. Look at the volume starting to come in. They're starting to buy corn. You can see, if you see my volume bars down here on the bottom. So they're coming in now. And with wheat and coffee and everything else moving up, I think this one probably has more upside potential in the near term than the others, because I think it'll play a game of catch up. So you can see some of the potential targets still marked there for corn. Cow kind of holding its own. Cow, this has hogs and cattle, and they tend to not do so well when the grains are going up, because that's an input to the farmer's cost, on those feeding those things. Sugar, again, SGG, just another ETN there. BAL, cotton, also in an uptrend. So again, this is stock market's trying to pick its direction right now. Looks to be toppy to me, but the commodities look to be bottoming. And this is one that if you want a one-size-fits-all, you've got cattle, pretty good chunk, about 14%, and also hogs at about another 8%. So you're talking about, I haven't updated this in a while. You can go to the site DBA, Google a term DBA ETF holdings, and you'll get to Invesco's site, and they'll give you the updated holdings. But pretty heavy weighting there. So as I've said lately, my preference is to pick the most bullish ones out of the ag commodity arena, and then layer into those, because they have both futures or ETNs if you don't trade futures. This one happens to be an ETF, but again, it's a one-size-fits-all, and it's looking good. I've been talking about it for a while. Big divergent low, bullish falling wedge right here. It broke out, and it's been in this basing pattern, which it's starting to crack above today. You can see my targets marked there. So again, if you're looking for diversification in your portfolio, or just something for outright somewhere to put your money to make money, not just to diversify. That's a big part of it, in my opinion. Asset allocation, diversification, but pure play because the charts look good, for no other reason. UNG, I've covered that recently. Here's the chart on the daily chart with some potential targets. I've given you the 60-minute chart with targets. There are divergences forming, and I'm watching those. They could play out for a correction, a pullback. Could even put the brakes on the entire rally. But I want to show you one other chart here that I haven't showed you recently. Before we get to that chart, it's a longer term chart of natural gas. Here's the 60-minute chart at NG. And remember, if you can also trade QG. That's the mini contract. It uses these same levels, but you just have a smaller leverage factor. So for those of you that want to trade futures, look at QG. Same levels here. You can trade because it just has a smaller leverage factor than NG. And so what we're watching here is a trend line. Any pullbacks to that trend line should provide an objective entry, or could provide a stop loss a little bit below it. There are divergences forming. That's giving me a little bit of pause right now. However, divergences are not a sell signal. Sometimes they pan out. They certainly panned out right here. You had negative divergence right there at that point, and that marked the end of that run. And then you had a trend line. So, and we also hit resistance at that point. You can see that level. So, and then there was your sell signal time to get out or short, and then that run ended with positive divergence. So that's where we're at now. So what I'm thinking here is we'll go on up. I'm still favoring a move up to that 1964 target. Where we'll probably get a reaction. Now, if we get to that target and we can pop above it, we could burn through this divergence and go on to hit that next target. So, I'm still long, and but I'm cautiously bullish, wanting to see a little more upside, and we'll most likely be booking profits there. Or what I'll do sometimes, if I think we could run, because I'm about to show you a chart where I make a case for a much larger rally, is I'll just at that point, instead of booking profits there, I'll just tighten up stops and let it run. I'll raise the stop there, set a good to cancel, let the position run in case it does that. Or maybe below the trend line. Again, it all depends on where we're at the time. All right, here's the chart I wanted to show you. For a while now, I've in the past I've showed you a chart that I have. This isn't it, but it shows you seasonality. That natural gas, I've highlighted, that it tends to rally either in the fourth quarter in the fall each year, or early winter, or early in the year. If you don't get a rally, October, November, December, usually later in the year, you get one early in the year, and that's obviously seasonality. It gets cold. It all depends on the weather. There are supply and demand factors, of course, that come into play with natural gas as well. But weather plays a big part of it. But what I did here, I said, what, let me take a look. Okay, here we are. We're in, right now we're in late July, end of July. And so what I did, if you can see these blue lines, I put cycle lines on the chart. I don't know what this one. Oh, I've got to turn this off. There it is. I had a line there that was throwing me. All right, so what you can see here, I hope you can make out in the video, are these horizontal lines, or I'm sorry, vertical lines that show where we're at today. And then I did a 52 period cycle. So this is a weekly chart right here. Weekly chart, and there are 52 weeks in a year. So by putting cycle lines on and stretching those lines out to 52 period intervals, that shows me every year where we were. So what I did is we're going back to October of 06, just because I had this chart already defaulted for that 15-year period or whatever it is. Interesting to note, look at these inflection points around that time. There's a cycle line right there. It came just a little bit later. There was an inflection, but in what I'm looking for, the way I interpret or analyze this chart is, you want to see a trend. First of all, what's the trend leading up to this point in time? At this point, it was clearly bearish. Again, it would have got you in a little bit early there, but if you went long, you caught, really that rally didn't end until right here, but at least you would have caught this initial rally right here. A year later, around this same time, look, we bottomed just right after that, had this big rally there. There, we were in a downtrend and there was no bottom there, okay? So I'm going to point that out. It's not perfect. The following year, 2009, again, this time almost perfect to the button. So there seems to be something going on around this time of year, not always, but especially after an extended downtrend where you get these inflection points. This one, it didn't nail the bottom, but there was an inflection point right here. You can see there was a little correction, and then right around that time, again, here's the line right there. I missed it to the left a little. There was a rally. Here, we bottomed right there to the button, and we had this rally all the way up to here. An inflection point there. Stalled out, but it didn't go down, and you did get a rally out of it. So bottom line is, go back in time, if you would have just bought natural gas randomly at this time each year, end of July, held it with a stop, put a stop in place, let's say a 3, 4, 5. Well, natural gas is volatile, so I didn't think this through yet, but let's just say you did a 5, 6, 7% stop with a 15% or plus upside, because natural gas is volatile. You would have done well. And more importantly, if you bought it after a big drop like this, and so here we are now. Here's the last few years, by the way. This is today right here. We have positive divergence, and I like to take not only the seasonality thing that I'm looking at here, but also what do the technicals look like. The big rallies came back here. You can see we had positive divergence. This one we had positive divergence. That one we already had a divergent low, and we were in the beginning of a rally, and no divergence here, but again, right on the button a year ago, where we had a nice rally. And how much was that? Let me measure it for you and just kind of give you an idea, because again, I told you nat gas moves pretty big when it moves. That's a 45% rally right there. I just measured up, so it doesn't look like much, but so there it is, guys. It's just simple, putting the odds in your favor that statistically buying around this time. And I don't know why. I don't know what it is at the end of July that causes this, but it seems a little bit more than random, these inflection points and these rallies here. And again, taken in conjunction with the fact there is positive divergence, does tell me, and where would we go? I have a resistance level up here about 250 right there. It's a pretty big resistance level. It would give you an idea for a swing target. Like everything, it may or may not pan out, because it's certainly not 100% of the time, and that's what stops are for. If it gets there, I'm going to measure from where we're at now. This is an end-of-day chart, so that's yesterday's prices, but we're about the same level right now. That's a rally of about another 35, 36% right there to that 250 target. All right, I want to wrap it up here. I just want to say that if the market does correct, one of the best bang for your bucks, I think right now, other than shorting, the NQs, I favor that because I think it'll be a flight out of the top-heavy fangs. They lifted the market on the way up, but if the money flows go the other way, people start withdrawing money from index funds and those stocks themselves. I think they're poised to fall. Some of the ones that are high flyers in the Nasdaq, Tesla, Netflix, I think you'll have more downside on those two than you will on the fangs themselves or the Qs. So those are some opportunities. Crude oil, again, contingent. If the market does drop, I'm putting a heavier bet on crude than equities right now, because crude it tends to rise more than the stock market when things are going up and tends to fall more. And right now, price distortion's been thrown out the window with what the Fed's done to the market. Flooding liquidity, coming in and intervening in the the bond markets. What's happening is crude's trading on along with the stock market based on economic growth expectations, with the logic being if the stock market's rallying, that the assumption is we're going to see, we're seeing growth in the economy and future growth expectations, but that goes the other way too. So what I'm trying to say is I think if the S&P 500 drops 10% in the next month or two, I think USO will drop 20 plus. So more bang for your buck. Cuts both ways, so just keep that in mind with your position sizing. And then finally, I just had an alert on, as I'm doing the video here, Pan American Silver. I already, my thoughts there. I think there's a lot of meat on the bone for these silver stocks here. I made the case that silver's at resistance, and this one alone, looking at about a 16% drop, it's starting to crack the trend line. In fact, I need to pause the video. I think I'm going to take a position on this. The chart just looks too good to ignore, even though we don't have solid sell signals on the metals yet. I'm going to start layering into this one here. All right, guys, I'm going to wrap it up, get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.